private equity, if you do a leveraged buyout of a company, you are kind of asset managing it loosely at the private equity fund. But you have like a management team. You have a CEO still. You have a CFO, which I'd say is probably, is running the business, and I'd say you're probably much more hands-off in that.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Tucker Thompson. Tucker is the founding partner of Sweet Bay Capital, a multifamily real estate investing firm. Prior to co-founding Sweet Bay, Tucker began his career at JP Morgan, where he worked in investment banking and specialized in M&A transactions, debt raises, and IPOs. Tucker, I'm going to stop there so I can let you tell your story in your own words. I think it sounds better that way. But first, I just want to say thanks for coming on the show today. Thanks for taking the time out to join me. And I'm excited to hear your story.
Great. Thanks, Jason. I'm really excited to be here. But yeah, that was the start. My first job out of undergrad was in New York City, working for JP Morgan in investment banking. Like you said, wasn't actually real estate focused at all. More industrials and transportation, actually. But that was kind of a really good place to kind of start building my toolkit in terms of financial analysis and modeling and underwriting, and just getting familiar with the capital markets and just finance in general, as just kind of laid the foundation for a lot of the things that would be helpful later for when I got into real estate. So was at JP Morgan for a few years, and then had enough of New York City and made my way out to San Francisco, California. To take a step back, I'm actually from Richmond, Virginia originally,
Okay.
and wasn't quite ready to move back there yet. Wanted to try something else out new. So wound up in San Francisco working for a private equity fund that was also, where I was also mainly focused on investing in transportation and industrials companies. So went from kind of the advisory role to more of an actual investing role at the private equity firm. And that's actually where I met my business partner today, Max Shelton, where we both started at the private equity firm called Griffin Investors at around the same time. And while we were there, we both kind of became friends, and then also both started investing in real estate on the side. We're looking for ways to generate passive income to supplement our W-2 income, with the goal at first to eventually have a portfolio of single family rental properties and duplexes and things like that we build over the course of our careers and use that to help our retirement. I feel like a path that a lot of people go down. And what ended up happening was we started buying these student rental houses in Columbia, South Carolina, for University of South Carolina students. And we would each kind of take turns buying one, not pooling our money together or anything like that, but we were just very much talking all the time and looking at deals together and stuff like that. And after a few years, we had a portfolio of 5 of those houses between the two of us. And then at that point, we started to think more about our backgrounds. And, we both had strong finance experience and knew a lot about investing through our time at the private equity firm, just learning about raising debt, raising equity, structuring deals, doing the financial analysis, doing all the due diligence and stuff like that, combined with the experience and knowledge we gained through our own personal real estate investments, decided to kind of put our heads together and see if we could do bigger things. And through our relationships we had made with brokers and stuff like that, over the past couple of years, we're able to buy a portfolio of those same student rental houses, and that was in 2021. It was for a portfolio of 11 of them, which we were able to do a quick fundraise for, put together a little presentation. It was very crude, but went out to a bunch of people in our network and were able to raise the small amount of money that we needed much easier than we ever thought we could. We were really apprehensive because we didn't have any formal experience in real estate. We had never tried to do a raise like this before and had no idea what to expect, but we kind of just put the deal in contract and went for it. And it went much easier than we both anticipated. And after the transaction closed, we could kind of tell after the first 6 months or so that it was probably going to be a good one. And so that just gave us a lot more confidence to kind of start looking at new opportunities. And during this entire time, we still had our day jobs as well. So we kind of had our personal real estate investments, and then we closed this first syndication, and we're managing that while we still had our day jobs. And we actually did that for probably, I guess it was over about a year and a half from when we closed our first deal in 2021 to when we purchased our second acquisition as Sweet Bay. That was in February of 2023. We bought 2 multifamily apartment buildings in Roanoke, Virginia. That was about 40 units. And just before that, in January, we actually sold all the houses in Columbia from the first deal that we raised money for, and everyone 1031 their money into our second acquisition. So at that point, we had a really strong exit on our track record and had closed our second larger multifamily acquisition. And at that point, we felt like it was a good inflection point to try to pursue Sweet Bay full time. And that's when we officially launched it and put our website out there and got a brand, put the brand out. And that's also actually when we quit our full-time jobs as well to pursue this full time. So yeah, it was a long time of doing both our W-2s and kind of these managing investments and evaluating new investments on the side, which was challenging, but I think a really good way for us to start. So that's the story up to when Sweet Bay started officially about a year and a half ago. And I can keep going.
Yeah, well, let me, there's a couple of really, I think, cool things to touch on in there. One, I think your background, at JP Morgan and then subsequently at the company in San Francisco, as you mentioned, probably ties in pretty, you said, oh, we didn't have any formal real estate background, but I think I would assume that a lot of that, you found a lot of parallels between kind of what you were doing there and then what you were doing with Sweet Bay in terms of, as you said, like structuring the deal, raising capital, all of that. I think it's sometimes easy to think, oh, I don't know anything. You move into what feels like a new space. It's easy to think, oh, I don't know anything about that. But in reality, you probably, be interesting to kind of get your take on this. You probably were more equipped than you might have initially thought, given the background that you had.
Yeah, no, for sure. The investment banking and private equity experience translates directly into a lot of aspects of real estate investing. Particularly my business partner, Mac, focused on capital markets at Griffin. So his job every day was to speak with lenders or, JV equity groups and stuff like that. And then my focus was on deal underwriting. And then Mac actually later joined another private equity firm on the investments team as well. And so we really had the full spectrum of modeling and underwriting, knowing how to speak to lawyers, knowing how to speak to lenders, kind of knowing how to negotiate with them, knowing what investors care about when you're putting together a presentation and stuff like that. Lots of PowerPoint experience for making those presentations.
Yeah.
And the piece that was new was just the real estate specific aspects, which we were kind of able to just build ourselves by spending a couple of years putting our own money to work with our personal investments.
Right.
And then supplementing that however we could with, books or articles or just videos, wherever you can, about just trying to learn about all the different nuances of real estate. Probably the biggest difference is that, like in private equity, if you do a leveraged buyout of a company, you are kind of asset managing it loosely at the private equity fund, but you have like a management team. You have a CEO still, you have a CFO, which I'd say is probably, is running the business, and I'd say you're probably much more hands off in that kind of in that relationship than you are with probably your property management company, where you might be doing like weekly asset management calls or bi-weekly asset management calls with your regional manager, for example. Like, you're not quite as hands-on as we are today in real estate as we were in private equity. So that was probably the biggest learning curve. But a lot of those, like you said, a lot of like the fundamental skills that we do definitely translated really well.
Piggybacking off of what you just said, do you think that has to do just with scale, in the sense that, the private equity firm, I don't know what you had, assets under management versus, as you're coming in and you're having, the 11, I think you said the original portfolio of 11 and then some, 40 units. I think when people, as you scale up in the multifamily space, when you get, people get into the thousands of units under asset or thousands of units under management, now there's probably those multiple layers that you're speaking about with your private equity firm. Do you feel like maybe I'm wrong?
I think that's a good point. I think that because we'll eventually, we have a 200-ish units now, and I'm guessing that relationship probably will look a lot different when we have 2,000, hopefully, one day.
Right. Yeah.
And I guess maybe the comparison is there's some smaller private equity funds that are, basically investing or financing like a founder of a business who is trying to build something from the ground up, and you're probably a lot more hands-on with that than you would be if you're, buying a $500 million company with 500 to 1,000 employees or something, and like an actual like established management team in place and stuff like that. And the other piece about Griffin is that we also had a operations team. So the investment team, there'd be an investment partner, and then I was working under him as on the deal team, and then there would be an operations partner who was typically someone that was a former CEO or business owner in the industries that we were investing in, who actually speaks with like the CEO of the companies that we're buying much more frequently as well. So I guess in that way we had like the analogous comparison to that with real estate is having like your in-house asset management team.
Right.
That would be doing that as well, which Mac and I don't have today. So, but like you said, that's probably something that will happen down the road.
Yeah. And eventually I think that's what it comes down to. It's because you eventually will become your own bottleneck if you're, sort of doing everything yourself. And so people they bring it, whether you bring in an asset manager to work for you, or you, have additional partners doing that role, whatever, however the case may be. But if you have, thousands of units under management, now you may even become vertically integrated. And so then you have your own property management company and things like that.
Talked a lot about that too.
Yeah, it's, I think it's just a lot of it, just for people listening, I think it some of what you hear about, it just happens to be, where a specific investor, and in our case, real estate is the vehicle of choice right now, but that it's just where you are in that journey of scale, I think. And as you grow, your company grows with you, your, people, your team grows, that sort of thing. So,
but we've seen that already in the last year or two. With our first, so we had the student rental property, and then the second acquisition was for 41 units. That deal we were very hands-on with. I mean, we're still, part of it's because we're still learning and want to be involved and learn as much as we can as we're doing this. And part of it's also because we are extremely focused on making sure that the properties follow our business plan, particularly early on as we're building our track record. And then after the 40-unit property, we bought a 90-unit property, and then we bought a 60-unit property. And we, like you said, just don't have the bandwidth to manage those as closely as we did the first small portfolio, or even the second 40-unit acquisition. And I think it's been a good it's been steps towards relying more and more on the property managers to do things the right way and do things that we expect them over time, like you said, or else it just doesn't scale. And so I think our progression in terms of size and velocity of transactions that we're doing has fit, I guess, Mac and I's bandwidth well. And, we've kind of, we're managing our capacity to handle everything with the scale of our portfolio, I think, in a pretty smoothly. We're not growing too fast where we things are, falling apart, for example.
No, and that's an excellent point to that, is that, taking it at a pace that you can manage it and grow your team in a an easily scalable fashion without sacrificing performance of the properties.
Yep.
And so I think that's a great thing to touch on. And you said, go ahead.
Oh yeah, I was going to say that. One thing that was really helpful for us was the amount of time we stuck with our W-2 jobs. Mm-hmm. Like I said, we closed our first deal as Sweet Bay in October 2021, and we didn't leave our full-time jobs until February or March of 2023. And so during that time, we were managing the first investment and evaluating a whole bunch more. And that just bought us a lot of time to be able to review a ton of deals and pass on a ton of deals and refine our strategy and tweak our underwriting and just have a lot of reps with nothing really at stake, because we still had the benefit of our W-2 income and kind of that safety net where we could take as long as we wanted to find that next right opportunity and make sure that we were set up well for it to do well. I think that's really paid off. We're actually, that second acquisition was for was two properties together, a 26-unit property and a 15-unit property, and we're actually about to go into contract to sell the smaller of the two to lock in already. I think if we sell that one with where we've got an LOI and on the timeline we expect, it should be over a 30% IRR for that if you segregate everything and just look at that property. So that would be a really good outcome. And then also kind of just it de-risks that entire second acquisition, because we'll basically be returning everyone's equity within 15 or 16 months, and we'll still have that second 26 unit property that's performed extremely well just for further upside. So I think that kind of patience we took to do that second acquisition has really paid off. And yeah, we've seen that through the kind of the results of the first year and a half of the second deal.
Yeah. No, that's excellent, especially just, kind of given the market and the environment that we're in right now, like the timing of what you're saying in terms of, purchasing in 2023. And obviously there's lots of talk about interest rates and everything, and that's been a big piece of the puzzle, but you're evidence that, real estate still works. People are still getting deals done. People are still having success.
Yeah.
And it's
we
actually
were
refreshing to hear.
We were able to beat our rent targets while spending less than we expected on renovations, and also have our operating expenses come in below budget too. So it's really, yeah, it's gone. Maybe we underwrote it too conservatively, and maybe that means there are other deals that we're underwriting that we probably should have bought, but we're being too cautious about it. But yeah, it's really kind of outperformed.
Yeah.
On every kind of top line revenue and expenses. So yeah, we've been really happy with it.
Yeah. No, I underwriting too conservatively, I think that's not a thing anymore. I think you have to be. I mean, to be underwriting conservatively and beating all your projections, that's what everybody wants. That's what every operator wants. That's what every investor wants, right? Like,
yeah.
What you don't want is the opposite of that. And so
yeah.
It all ties together, like, doing it that way, but also the piece about, kind of scaling at a pace that was comfortable and manageable for you and your partner. It means, if you're only doing the good deals, that's like all of that ties in together. And so I think it's very, very smart, very, very smart tactics and approach to what you're doing. So good for you. What is your outlook on the future for Sweet Bay Capital? What are you targeting? Kind of where do you see it all going?
Yeah. I mean, the trajectory has so far has generally been increasing in deal size. Like I said, the first deal was 11 houses. It was probably 30 or 40 beds. The second deal was 41 multifamily units. The deal after that was 90. And the most recent one was 60, but kind of still trending upwards overall. I think we'd like to get into that 100 to 150 unit range, up to 200 units, and transact some there. Really just getting to the point where you can hire on-site management and have the property be able to support it is kind of the big threshold for us. And then, we'd like to build scale in some certain cities. Like you said, maybe one day we can bring in more management in-house and have the density in a single place to make that more efficient. In terms of deal sizes, like transaction size, we'd like to kind of get to that 10, 15, $20 million range pretty consistently. And then really hone in on the operations a lot and try to drive as much efficiency as possible before kind of going up past that size range, where I think we'll see a lot of the competition be a lot more sophisticated and also have really low cost of capital, which will be, another step up, but just in the difficulty of getting deals to work, and just more competition in general. We're at about 200 units now. I mean, I'd love to say that we're going to acquire another 100 or 200 this year. It's really, who knows? We might get a deal tomorrow that we love, or it might not come for 3 or 4 months or more, especially with, the volatility in the treasuries recently, which is really hard to predict too. I mean, personally, as buyers, as I say, we're our portfolio is still really small, so we're definitely skewed more towards like a buying mentality than a selling mentality. And so for us, the longer rates stay higher could end up being good for us just in terms of creating more buying opportunities. But, transaction volume has still been really slow. So it's hard to say what's going to happen, but, hopefully we'll have some more chances this year.
Yeah, I think nobody really knows what.
Yeah,
all the experts' predictions they have turned out to be wrong plenty of times.
Well,
so.
My view on that is just whatever the consensus is today probably isn't going to happen. And we try not to. When we're underwriting, we try to find deals that we think will be successful regardless of the macro events. Like we want NOI growth to be the primary factor in what is, causing the return at the end at exit. We don't want to underwrite to, an assumption that the next buyer is going to be able to get 4% or 3.5% agency debt, and sell for like a super low cap rate. Again, maybe that's being too conservative, and maybe with the way cap rates have come up, you could be right if you assume that cap rates will be flat from entry to exit or compress. But it's something for us where we really just want to make the deal driver something that isn't within our control,
Right.
which is rents and operating expenses, to more so than interest rates.
Yeah, no, absolutely, very, very smart. Are you focused still around Virginia, or what markets are you looking at?
The target states are Virginia, North Carolina, and South Carolina. So I mentioned earlier that I'm from Richmond, Virginia originally. I'll actually be moving back there from San Francisco this summer. My business partner now has since moved back to Raleigh, where he grew up. So they're both states that we know very well. They're also states that are geographically convenient for where we'll be, and then they're also states with a lot of positive demographic trends, population trends, job growth, and just a lot of markets from hot core plus markets like a Raleigh to also some tertiary markets that we think are interesting when it comes to like the basis and cap rates there, as well as just having like less sophisticated management and more value add opportunities, and yeah, all just kind of within our reach. I think eventually Tennessee and Georgia are probably the next logical areas to expand, but for now, for us too, there's plenty of ground to cover in those areas.
Yeah, there's plenty of opportunity in Virginia and the Carolinas. I mean, I think it's sometimes I've felt like when I was first starting, I was looking at too many markets. I was just like, oh, there's you can and it's fine. You can it's probably good practice on underwriting and things like that to just get your hands on as many deals as you can. But I also think you create a competitive advantage by focusing on one or two markets, because you can build your team there. You understand, because the expense ratios aren't going to be exactly the same in every single market. Like there's just things that you can get further dialed in by being really focused, and then if you get to that point of being vertically integrated, now you have control of some of those expenses even at a higher level, and if you're driving for NOI growth, which that's really realistically what we should all be striving for. It's a very, very smart strategy. I think I love it.
Well, so like our first deal, I think, as I said, was student rentals, and for like this first 6 months after that, we thought we would look for another student rental deal, and it was niche enough where we were looking at deals across the country, like in Indiana or in Georgia or Alabama, Texas, like all over, and to get enough deal volume where we thought it would make sense. And after a few months, that's when we pivoted to just look at multifamily or traditional, like conventional multifamily, because there's just a much larger supply of opportunities to look at. And then at the same time, we could narrow down our geographic focus a lot more. And that way, you can go deeper in a smaller number of markets. And in terms of understanding the market, really actually like knowing who the players are in the market and knowing, getting to know specific apartment buildings that you'd like to buy one day.
Right.
And like going that granular. And then also just being able to develop strong relationships with the brokers in those markets as well. Especially if you're local too, which I think can be hard if you've got a ton of different brokers spread out across the country and you just don't have the time to develop strong relationships with all of them, which is, I think, really important for sourcing. And then finally, that ties into what you're scaling with with what you're saying about the operational efficiencies. At some point in the future, we'd like to have the density where we can buy renovation materials in bulk up front and store them somewhere, and know that we have a couple hundred units within a certain MSA that we're all going to use the exact same LVP floor and all the exact same appliances and stuff like that, and start like cutting down those materials costs, which is it's just doing all those sorts of things is just much easier when you're closer together and don't have to worry about shipping and stuff like that, and just have the ability to buy a much larger volume of materials at a single time for a single place as well.
Yeah, no, those sorts of efficiencies with just buying in bulk and managing labor costs and things like that, just you really can be a huge driver in terms of NOI. So really, really, really smart. Well, Tucker, let me switch gears here so I can ask you the questions that I like to ask every guest. First one's based on the name of the show. What is your why? What's driving you? Obviously, I think you've had a ton of success already, and not planning on stopping anytime soon. What's pushing you forward?
I really focus on just. I think my business partner Max Shelton does too, and just on how we can be constantly improving with things, and just trying to drive efficiencies wherever we can, not necessarily for our existing portfolio, but also things we'll be able to leverage for future acquisitions. Like what I was just talking about, like trying to source materials directly from manufacturers and kind of getting that volume to be able to do that and make it efficient. And also just how we can get better at making Sweet Bay more efficient, and what are like questioning everything we can about how things have been done traditionally, and if there's other, if there's things that we think we can change to make things more efficient, whether that's, figuring out who we should hire first, or, maybe we can leverage software and virtual assistants to get a lot of the benefits of like a first employee, but at a much lower cost. And just trying to find solutions to those kinds of problems, I think, is really interesting. In terms of deal specific things, I kind of view every deal as kind of like a puzzle or a mystery in a way. And I think it's fun to try to figure out like what the angle is for an investment, or what's like the red flag that makes you say no. Like why is this person selling? Like what do they know about the property that we don't know? Is there some new development that's coming, or is the plumbing really bad, or is the owner just missing something that we see that they don't see? I think that's probably the fun part about getting into like digging into new deals. Um, so those are some of the whys, and then I think we both really focus on just trying to deliver and do things the right way for both our investors and also ultimately the tenants of the properties. Um, with our investors being extremely transparent and being, if they're investing in multiple different real estate firms, like trying to be the one that gives them the most clarity and the most amount of transparent communication that we can, just to really build that trust. And then with our tenants, really trying to get our returns by providing value to tenants, by improving the properties that we invest in and running them well and making sure that they have a good experience, and kind of getting our returns that way versus just being like a low cost manufacturer of some product where you're just trying to cut costs as much as possible to try to eke out your return that way. So yeah, those are some of the whys.
Yeah. Well, and I mean, on that, tenant retention and occupancy are
and that's it's a cost. It can end up saving you in the long run if you keep your tenants really happy.
Yeah, exactly. Happy tenants, they stay longer. They tell their friends. It just makes you can have good reviews. I mean, there's just so much to it that, the analogy to sort of a low cost manufacturing thing. That's that. A lot of people take it that way, but you're not. That's not going to set you up for long term success. So I think really smart. Tucker, tell us.
We really. Sorry, I cut you off. We really capitalize our deals up front with a ton of cash to make sure that we, have the budget to do all those things too. But sorry, go ahead.
Yeah. No, just the next question. I like to ask people something to tell us something about yourself that isn't common knowledge, special skill, a hobby, something just to let listeners know you a little better.
Well, we talked a lot about my background. It wasn't always destined to be finance focused. My mom was actually a nurse, and her dad, my grandfather, was a doctor. And so and my dad was in finance. So I was kind of weighing the two career paths for a while and thought I might want to go to medical school eventually. And so I actually used to be in college, was an EMT for a volunteer rescue squad. And so that was just a completely different, experience point in my life when I was weighing kind of which career path to go through, but really, really cool one. And I thought kind of gave me a lot of just life experience early on. Wasn't something I ultimately wanted to do long term, but was still just a really meaningful experience for me growing up, being able to volunteer a lot, and then also kind of just get just work with a variety of different people and in a variety of different circumstances, and just learning a lot through that, just general life experience.
Yeah. Well, now you can help doctors manage their financial futures. Yeah, exactly. So you can still related. There's a lot of people that are looking to the doctor world to find investors and things like that. So
I should use that as an angle in. That's
really good. You're like, I saw what my grandfather experienced firsthand. You can use that as a sort of opening line. But no, I mean it's needed. People need help with figuring out what to do to set themselves up for long-term financial health. So when people hear this and they want to reach out, what's the best way?
LinkedIn's probably the best way, or our website. You can search on LinkedIn, just Max Shelton, my business partner, or me, Tucker Thompson. And then our website is just sweetbay-capital.com, and that's got our emails on it. And those are probably the two easiest ways to get in touch with us.
Good. We'll put those in the show notes. My last question for you, what piece of advice would you give to someone who wants to get started in real estate? They hear this, they're inspired by your story, and they're thinking about making that leap. What would you tell them?
Yeah, I think we touched on this some already, and I'd say just be patient. If you are thinking about getting into real estate, as kind of that we've talked about, then I think that implies that you probably have a full-time job. And I'd say just don't look at that as a burden. Look at it as something that provides you with a lot of flexibility to figure out where, just to figure out what your strategy is going to be and find that first, good opportunity, or the first few good opportunities. And, once you take the plunge, and if you decide to end up pursue real estate investing full time, you might not be able to get back your old W-2 that easily. So just take your time with it, and use that as a way to make sure you wait for the right first pitch.
Yeah, no, I agree. I think it's, and maybe this has to do with the shift in the markets, but there was a time when people were all about like, oh, get into real estate so you can quit your job, and it's maybe worth considering kind of running those parallel for as long as you can, for so you have that safety net, and you have some ability to invest the money that you're making in your W-2 job into your business and grow that, and until the business is self-sustainable. So I think it's a great piece of advice. Well, Tucker, thank you so much for coming on the show. I appreciate everything that you shared today. I think some really smart strategies and approach to it. So thank you for being here.
Thanks, Jason. It was really fun talking to you.
Yeah, thanks. And folks listening, I know you're gonna get a lot of value out of this episode. Make sure you connect with Tucker, and please rate, and review the show so we can get more great guests. Thank you for listening.
Please reach out. I'm happy to talk to anyone about anything. If they've got any questions or anything like that.
Yeah, and your website and LinkedIn, all of that, the connections will be in show notes for anyone listening. Thank you again.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?